Good evening and welcome to the Perspecticast, the companion podcast to the Panda Perspective Substack. This week we're having a special feature on the Substack. We are doing a macro week. We are going to be focusing on the macro issues facing the Chinese economy to take stock of what the tariff impact can and should be, and to see what the opportunities are, what the opportunity set is at the moment, quite frankly. This came about through a fair number of requests, mostly from lay people, so people who are not following this very frequently, but they said, look, now we know your point of view, but before we thought you were just nuts. Now maybe there is something to what you're saying. So please talk us through it, right? And ever the gentleman, I thought, you know what? All right, okay, I should probably create a single place where I can put all the arguments in together. And again, given the focus, I decided against doing one long piece, and I split it up into three. So now we'll be publishing right after this podcast drops. In immediate follow-up will be the first macro piece dealing with the overall state of the China economy, where we are, where we're going, how all of that is playing along. And then on Wednesday, we will have a real estate update. This has been a long time coming and elephant in the room type thing, right? I mean, we were already talking about it for some time, and I feel like, yeah, okay, now it's time to actually address it. And then on Thursday, we will have a very special consumer-focused essay discussing what's going on the consumption side and just hitting some of the consumption points that maybe we haven't paid enough attention to. Overall, I think it's well worth your while reading the entire thing, so please do when it comes out. I wanted to take this opportunity to kind of set the stage for those pieces coming. First and foremost, we need to establish the fact that the current run rate of Chinese growth is about 5.4%, which is way ahead where people were expecting it was going to be, right? I mean, let's not forget that major houses have Chinese growth for the year going into the year at about 4.5%, right? We're running a full 100 basis points ahead of that clip, right? That's quite a bit. Now, I know that some people will point to fiscal receipts and say, look, the fiscal receipts are 3% behind last year. That must be something terrible. Well, no. If part of your stimulation is tax breaks, right? Well, you're going to end up in a situation where if you have a few of them, you will have less fiscal revenue coming in. Also, continued restructuring of the land sales obviously drives local tax collection and it continues to drive it down. Again, do not well, I mean, do if you like, but if you do, you will not get an accurate picture of what's going on in China. So do not equate fiscal receipts as a proxy for GDP growth. Now, of course, it's better when the fiscal receipts are growing without the corresponding change in taxation levels. But given that we know the situation as it is, right? Given that we know that industrial profitability is sort of being deprioritized in favor of an R&D surge and in certain elements a big deflationary push. So, in electric vehicles, for example, we will continue to see a race to the bottom in terms of prices. And some of the appliances as well, we're seeing quite, significant price wars develop. So in that environment, all of this tends to imply that it'll be harder for industrial enterprises to make profits, although the very good ones will continue to do thusly. And so that is another thing that to look out for, right? That the beneficiaries of the coming changes in spending, the beneficiaries of the coming changes in government outlook on things, the beneficiaries of compensatory stimulation are not going to be everybody, right? I mean, kind of should go without saying, but sometimes it's still worth reminding people that just because we have across the board stimulation doesn't mean that everybody is going to get in. Not every sector, and within the sectors that are going to get the support, not everyone is going to be in a position to actually take advantage of it. In electric vehicles, for example, right, it's quite clear that the bifurcation is very real, and we're now having three almost bifurcations where pool number one is just BYD and nobody else. BYD is in a league of its own. It continues to go from strength to strength, and the challenge for them is to get approvals for all these international plants that they have planned with the Latin American expansion has been not put on ice, of course, but before getting the approvals, the central government wants to see that that BYD is not just building assets that will then be either underutilized through sanctions or taken over by some American company, right? I mean, that's clearly what they wouldn't want to see, but it is my belief that the balance of probabilities probably means that these deals will get done and these plants will get built because BYD wants to service the Latin American market first and foremost. Similarly, in the domestic market, we have a group of well-developed local producers like Geely Group, like Huawei adjacent producers who are growing, doing a really good job, and doing a pretty good job of staying alive, right? They're relevant, they got volume, and they continue, and they can participate in the price challenges. We also have Xiaomi and Li Auto that stand out through the strength of their brands that continue to do well in terms of sales numbers. And obviously, they continue to rely on knocking it out of the park when it comes to models and people's perceptions, right? There is obviously, with Li Auto in particular, there's lots of talk that Li 9 is just not as good as Link 9, for example, or the M9 that the Huawei affiliates have put out. Quite frankly, it seems to not matter quite as much. Now, of course, there is a dent in sales, but that we can attribute to the fact that Shanghai Auto Show is starting and a new design, a variant of Li 9 should hit the shelves. But otherwise, the sales remain quite healthy, and there's a lot of enthusiasm for the i8, the all-electric SUV. And then the last bucket is, of course, the companies that need to show that they can get to scale, right? And this is where we'll find things like NIO, Xpeng, Leapmotor, right? But the difference is that in the case of Leapmotor and Xpeng, at the very least, you have a big corporate partner in the shape of Stellantis and the shape of Volkswagen who may come in and help restructure if everything goes terribly. But the problem for NIO, for example, is that they need to grow without one. And I am wondering if maybe it's a game of musical chairs that ended at a slightly inopportune time for them, because who is left to take them to the dance? And really CATL, right? And CATL is more interested in NIO Power, which they're majority shareholder of now, and they might just take it over eventually should new sales not pick up. So is that really the right kind of corporate partner? I don't know. Really remains to be seen where they go from here. But this is not a venue to discuss the prospects for new, but rather to say that yes, having established the market structure, let's do a thought analysis of what happens if the government does introduce greater incentives for cash for clunkers or any similar subsidy for electric vehicles or new energy vehicles. And you'll see that all of a sudden, because you're not constrained on volume anymore, right? It's not a point where everybody sells out of their electric vehicles, but rather there is healthy competition from across the board. The way it trickles down to players like a NIO or like an Xpeng is that the prices have been depressed, well, not depressed, but moved down so much through BYD's efficiency that the net benefit to the smaller guys is just incremental. And that causes me to wonder whether consolidation is upon us, like proper market consolidation in the EV space. And so I'm using this as an example to say that we need to be more picky when it comes to companies that we select. And obviously, this is what the portfolio part of the blog is about. And obviously, we discuss those issues both there and directly in the consulting calls. Obviously, do reach out if this is something that interests you, because I genuinely think this is a golden age of stock selection in China. We are very much at the precipice of new generals of the Chinese market, right? It's no longer just about the Babas and the Tencents, which, by the way, excellent companies, right? I mean, we've written about them. They've done a fairly good job restructuring themselves to begin with, right? To get more in line with what sort of is permissible these days and what they can sort of do. But that's not where the fun is. That's not where the growth is. Instead, it's the more exciting makers of things. Hard tech is what we're all excited about, right? And obviously, we've done a very good series on automation and robotics. Check that out. There's more. There's definitely more to come there. It's all very, very exciting. And my biggest takeaway from writing the three pieces, and they're almost done, right? I've written it's one long piece that I kind of started working on, and then just it got a little bit out of hand. It's over 17,000 words, right? I figured there is no way anyone has the time or the will to go through that much. So I split them up and, just rewrote and cut out and edited out bits and pieces here and there just to keep it more sort of manageable and more for focusing on main points rather than drilling down on the finer details, because it seems here that we're not at the stage where nuance matters all that much, right? We're at the point where we're just educating the broader market on the strength of arguments in China's corner. And my biggest takeaway was that, yeah, there is absolutely a negative side to the trade war, right? I mean, obviously, but if you follow the logic that we've talked about, that there's going to be replacement tariffs and there's going to be domestic stimulation, all that stuff, right? All of a sudden, you're like, it probably works out quite well for China in the long run, which is true. But long run is long, right? I mean, that timeline mismatch is very important to bear in mind. And so, obviously, with a very challenging April thus far and for the entire market with everybody selling down assets and the issues of ADRs being delisted, all that stuff coming right up. To me, that's the buy sign. The moment somebody says maybe ADRs get delisted, that's when the bottom of the barrel of negative arguments has been reached. From that point on, there's nowhere to go but up. I exaggerate, of course, but roughly that's what it feels like. And going through the economic arguments, it struck me that, yeah, absolutely, there is a negative consequence of this trade war that we need to deal with, but it's actually a lot more immediate than maybe one would think. But with this immediacy also comes the short-termedness, and that it's not very difficult to get over. And I feel like the market, given the valuations, given that they're so cheap is maybe an overused term, but certainly reasonable, they've been pricing something of this nature for a long time. And it's almost the Damocles sword of breakdowns of US-China relations has been over ever since Biden refused to roll back the tariffs when he got in, right? From that point on, it felt almost inevitable that something will come to a head. And now that it finally has, well, we can turn around and say, okay, well, let's look under the hood. Let's see what's really moving and going on and where the opportunities are. And just with that goal in mind, that we've done this focus on the economy. So we really hope that you like it. As ever, please subscribe if you haven't already. Please go behind the paywall if you haven't already. We believe it's worth it's worth your while. And with that, I wish you a very good week. Have a good time reading the economics pieces coming. The comments and questions, get in touch by all means, and have a lovely week ahead. Bye.